Hi, everybody. Welcome to your latest Carson's Take 5. Ryan and Sonu here. Sonu, there's a lot going on with the Fed. Feels like we talk about the Fed all the time. But this week, we're going to talk about what happens if the Fed cuts. Because there's talk they're going to cut interest rates in September. You're not so sure, but what are your odds they even cut? Then we'll say what might happen if they do.
You know, it's wishy-washy, which means I'm going to put a 60% odds of a cut. On balance, I think they'll cut, but I don't think it's a lock. And why? Because, yes, the labor market has weakened, and by itself, that should prompt the Fed to cut.
Right.
But inflation's also come out on the harder side, right? You take out food and energy, and a lot of people watching this video will probably argue you shouldn't take it out. But, you know, that's what the Fed does, right? To see what are the underlying structural forces on inflation. And that's why they take out food and energy. And we have a few things going on. We have disinflation on the shelter side on housing, but we have, you know, tariff impacted inflation showing up in core goods, things like televisions, video game consoles, all stuff like that. Prices were going down. Now they're not. They're actually going up, right? So there's an upward force on inflation. And then strangely, core services, right? Restaurant prices, seated dining prices are going up. Pet services are going up. Dental services are going up. I mean, I know you have pets, Ryan, and, you know, you've been to the dentist recently also. So all I have to say, thank you for adding to the inflation problem, my friend. No, I'm kidding.
Yeah, so my kids went to school today. It was the first day of school here in Ohio, and I think all three of my kids went to the dentist in the last 2 weeks. You cram all this stuff in, and I went to the dentist. So yeah, we're spending a lot on the dentist stuff over the past month or so.
I have a few, appointments. I was going to call it a meeting. You don't really meet your dentist.
Right? That should be a Zoom call with your dentist. That sounds a lot more pleasant, doesn't it?
Yes, for sure. There's an idea for you. All right. But let's say they do cut, right? And one question is, wait a minute, because a lot of people are like, stocks are at all-time highs. Things are looking fine. Cuts have been good for stocks, right? Especially more cyclical stocks like small cap stocks, things like that. They get a boost, right, when the Fed cuts, at least immediately. So a lot of the market thinking has been like, wait a minute, will the Fed even cut? But you've looked at the history of that, right?
That's right. You know, you think, okay, why would the Fed even cut if stocks are up a whole bunch? Well, because they have a dual mandate. Their dual mandate is keep prices under control and keep the labor market fully employed. I mean, that's the dual mandate. Yes, they're paying attention to what risk assets are doing. Let's be very clear. But Sonu, we talked about this probably a year ago, give or take, in these very Take 5 videos. We found 20 times the Fed actually cut interest rates with the stock market near all-time highs. The good news, a year later, stocks are up 20 times. Now, last year, they cut 3 times in September, November, and December with stocks near all-time highs. We're not there yet, but there's a good chance we're probably going to be 23 out of 23, this time in September, or I'm sorry, by the end of December. So again, The old saying, don't fight the Fed, just something to think about. Now, one more, I got thinking of this. Actually, our friends at Ned Davis did some stuff on this, and I kind of built on it. But the Fed cut in December. Now they're probably going to cut in September, like you just laid out. That's 9 months. So they cut, then they took a long break. I looked times the Fed took a break between 5 months and a year. Okay, so a good extended break after cutting, long break, and then start cutting again. Good news again, 1 year later, S&P's higher 10 out of 11 times with a median return like up 14, 15%. Okay, you tend to get continued strength after a long pause. They start cutting again. So those are just two things to think about. But I'll say this much: if that happens, those two things are not bearish, which hopefully can jives with our overall still fairly optimistic view on this overall global bull market and bull market we're in the U.S. So looking at the time, we got a couple more minutes. What else do you want to add on the Fed, interest rates, inflation, any of that stuff?
I mean, just to add to your point about, you know, they've cut a little bit, then they waited. Now, let's say assuming they cut again. What we really want is we don't want them to cut too much. I know the president wants them to cut rates down to 1%, but it's safe to say I don't think that's going to happen. No. If they do cut to 1%, honestly, we'll be in big trouble because that means the economy is probably in a recession.
Yes.
What we want to see is a few cuts, but not too many cuts. Right, a few cuts just to provide enough bounce to the economy. Right now, rates are at what we would call a restrictive level. I would argue it's a very restrictive level. The Fed would argue it's only modestly restrictive, but you know,
they did invite you to the party, so you don't get your opinion. Yeah,
but either way, it's restrictive. Let's remove that restriction. provide some level of easing to areas of the economy that need it, whether it's lending, housing, things like that. And I think, whereas if they cut a lot, let's say by 2 percentage points, 3 percentage points, I don't think this is going to happen, but that means we're in big trouble, right? We got bigger things to worry about.
Yeah, it's the old saying, be careful what you wish for, right? Because again, the last time they cut aggressively, like really, really aggressively, was a 100-year pandemic when we shut down the economy. Like, we don't really want to go there. And the honest truth, this time a year ago, Fed's fund rate was about 5.5%. They cut a couple times last year. Now we're at 4.5%. If they take it to 4% from now until the end of the year, which maybe could happen, is that really going to make a huge difference overall? I mean, on the margins, maybe, but again, it could just be enough to grease the wheels. And one other thing that I'll add to what you said there: small businesses historically do not like higher interest rates. I know we have a lot of small business owners that listen to these Take Fives. You like higher interest rates? Usually no, because it's harder to get financing. It's just kind of it just isn't always that good. So again, that can help small businesses, really help the housing market. Those two things have struggled, honestly, this year with, as you said, a little restrictive interest rates. We're probably near the end. Sonu, anything you want to wrap up with?
No, I think so. By the time the video comes out, Fed Chair Powell would have made his comments at Jackson Hole.
Yes.
Everyone's waiting.
Disclosure time. We don't know what he said.
We are recording this on the day before that, so we have no idea what he said. I wish we could get comments. I mean, I saw a picture of him at the airport at Jackson Hole. He didn't look too happy, so I don't know what that means. So.
Lost his luggage, maybe. I don't know.
Yeah, maybe. That's a Fed chair for you. But, there may be a lot that may happen over the next week, a lot of noise related to that. But at the end of the day, what do you want to look at? What are markets doing? What's the economy doing? We don't think the economy is in a recession. So we don't think you need a lot of rate cuts. But I think at the margin, a few rate cuts will help.
Well said there with all of that. This is, again, the latest Carson's Take 5 with Ryan and Sonu. What happens if the Fed cuts? We're going to have to stay tuned. We'll see you by next week. Take care. Thank you.